Before we begin, take a breath and imagine this for a moment. In a quiet room in Basel, Switzerland, far from cameras, press briefings, and social media noise, some of the most powerful financial decision makers on earth leaned back in their chairs and said something chillingly simple: we're praying nothing goes wrong. Not planning, not forecasting, not even confidently managing, but praying. When the people who control global liquidity, currency stability, and the plumbing of the financial system resort to hope instead of certainty, it's not drama, it's a warning. And today, you're going to understand exactly why those words matter, what that secret meeting was really about, and how it connects directly to your savings, your investments, and the future value of money itself. The city of Basel doesn't usually make headlines, and that's exactly why it matters. This is where the Bank for International Settlements sits, often called the central bank of central banks. Unlike the Federal Reserve, the ECB, or the Bank of Japan, the BIS doesn't answer to voters or politicians. It's a coordination hub, a place where governors quietly compare notes, align strategies, and sometimes admit fears they would never voice in public. Historically, Basel meetings have preceded major shifts in financial policy. In the late 1970s, it was inflation and currency instability. In 2008, it was the freezing of interbank lending that nearly collapsed the global system. In 2020, it was the sudden realization that shutting down the world economy would require monetary creation on a scale never before attempted. Each time, the language used behind closed doors was far more candid than what the public heard later. And this time, the phrase, "we're praying nothing goes wrong," signals something deeply unsettling beneath the surface. To understand what was discussed, we need to talk about the fragile balance the global financial system is sitting on right now. Over the last 15 years, central banks have transformed from lenders of last resort into permanent market participants. Trillions of dollars were created to stabilize markets after 2008. And then again during the pandemic. Balance sheets exploded. Interest rates were pushed to zero, and in some cases below zero, something previously thought impossible. The logic was simple. Cheap money would encourage borrowing, stimulate growth, and prevent deflation. And for a while, it seemed to work. Asset prices soared, stock markets hit record highs, real estate values surged, and risk disappeared from the vocabulary of many investors. But beneath that surface calm, pressure was building, like steam trapped in a sealed container. The problem central bankers now face is that reversing these policies is far harder than implementing them. When inflation surged globally after years of monetary expansion, rates had to rise. That exposed vulnerabilities everywhere at once. Government debt levels, once manageable under near-zero rates, suddenly became heavy burdens. Corporations that survived only because of cheap refinancing found themselves struggling. Banks holding long-dated bonds purchased at low yields watched their market values collapse as rates rose. You may remember headlines about bank failures, emergency liquidity facilities, and weekend rescues. Those weren't isolated incidents, they were stress fractures forming across the system. And when officials in Basel say they're praying nothing goes wrong, it's because they know the margin for error is razor thin. One of the key concerns discussed in such meetings is something called systemic liquidity. In simple terms, it's the ease with which money flows between institutions, without fear or hesitation. When banks trust each other, money moves smoothly. When that trust erodes, even briefly, markets can seize up. In 2008, this freeze nearly collapsed global finance within days. Today, the system is larger, more interconnected, and more leveraged than ever before. Derivatives exposure runs into the hundreds of trillions in notional value. Shadow banking entities operate outside traditional regulations. And sovereign debt levels have reached historic extremes. According to BIS data, global debt has surpassed 300% of world GDP, a level that leaves very little room for policy mistakes. When you're standing on a stack that high, even a small wobble can be catastrophic. This is where precious metals quietly enter the conversation, even if they're not always mentioned directly in official summaries. Gold, in particular, plays a unique role in the Basel framework. Central banks classify physical gold as a Tier 1 asset, meaning it carries no counterparty risk. Unlike bonds or currencies, gold doesn't depend on someone else's promise to pay. In times of stress, that distinction becomes critical. Over the past decade, central banks have been net buyers of gold, and the pace accelerated notably after geopolitical tensions and financial sanctions highlighted the risks of holding reserves in foreign currencies. This isn't a coincidence. When policymakers worry about things going wrong, they gravitate toward assets that have survived every monetary expiry. Meant in history. Silver, often overshadowed by gold, has its own strategic importance. It straddles the line between monetary metal and industrial commodity. It's used in electronics, solar panels, medical equipment, and advanced technologies, while also retaining a long history as money. In periods of financial instability combined with industrial demand growth, silver tends to experience heightened volatility. That volatility isn't random, it reflects competing pressures from real economic use and monetary hedging. When you hear about secret meetings and whispered concerns, understand that markets for metals often react before headlines do, because they respond to underlying stress, not official reassurances. What makes the current situation especially dangerous is the psychological dimension. For years, markets have been conditioned to believe that central banks will always step in, always provide liquidity, always prevent collapse. This belief, sometimes called the central bank put, has encouraged excessive risk-taking. But there are limits. Inflation constrains stimulus, political pressure constrains bailouts, and public trust constrains credibility. When officials privately admit they're praying nothing goes wrong, it suggests they're acutely aware of those limits. Hope is not a strategy, especially when the stakes involve global savings, pensions, and currency stability. Think of the financial system like a massive suspension bridge. For decades, engineers kept ingy weight because the bridge seemed strong enough. Cars, trucks, even heavy machinery crossed without issue. But now, cracks are appearing in the cables, not visible to drivers below. The engineers gather at night, shining flashlights, tightening bolts, and quietly wondering whether the next storm will be too much. They don't announce panic, because panic itself can bring the bridge down. Instead, they issue calm statements while privately crossing their fingers. That's the moment we're in now. So when you hear a phrase like, "We're praying nothing goes wrong," don't dismiss it as exaggeration. Hear it as an admission of complexity, fragility, and risk at the highest level of global finance. It reflects a system that has been stretched to its limits, sustained by confidence, coordination, and constant intervention. And it raises a critical question for everyone watching. What happens if something does go wrong, and who bears the cost when it does? Because the answer to that question reveals why those closed-door conversations in Basel matter far more to ordinary people than most headlines ever will. When something goes wrong in the global financial system, the cost is rarely borne by institutions alone. It shows up in quieter, more personal ways: the purchasing power of your salary shrinking, the value of your savings eroding, the price of essentials creeping higher while wages lag behind. Central bankers understand this, which is why their fear isn't just about market volatility, but about losing control of expectations. Money at its core is a collective belief system. It works because we all agree it works. Once that belief starts to crack, even subtly, restoring it becomes exponentially harder. In Basel, much of the discussion revolves around managing that belief without triggering panic. Publicly, officials talk about soft landings, normalization, and resilience. Privately, they examine worst-case scenarios. What if inflation proves sticky even as growth slows? What if high interest rates trigger a cascade of sovereign debt problems? What if a major financial institution fails in a way that can't be easily contained? These are not abstract questions. They are live risks, backed by real numbers. Consider government debt servicing costs. In the United States alone, interest payments on federal debt have surged past $1 trillion annually, rivaling defense spending. In Europe and Japan, aging populations and weak growth make similar burdens even harder to manage. When rates rise, governments face an unpleasant choice: cut spending, raise taxes, or borrow even more at higher costs. None of those options inspire confidence. This is why liquidity backstops and emergency facilities have quietly become semi-permanent features of the system. Programs that were once described as temporary are extended, renamed, or folded into new mechanisms. From standing repo facilities to swap lines between central banks, the financial system increasingly relies on constant support to function smoothly. Think of it like a patient on life support who appears stable, but only because the machines are running non-stop. The moment support is reduced, underlying weaknesses resurface. In Basel, officials are acutely aware that they cannot easily withdraw these supports without risking instability, yet maintaining them indefinitely carries its own dangers, especially inflation and asset bubbles. Another critical topic in these meetings is currency confidence. Over the last few years, the use of financial sanctions and the weaponization of reserve currencies have altered how countries think about risk. Nations that once assumed their dollar or euro reserves were untouchable have started to question that assumption. The response has been subtle but significant diversification. Central banks have increased gold purchases, reduced exposure to certain currencies, and explored alternative settlement systems. This doesn't mean the dollar is about to disappear, but it does mean the system is slowly fragmenting. Fragmentation increases friction, reduces efficiency, and makes crisis management harder. When everyone is playing by the same rules, coordination is straightforward. When blocks emerge with competing interests, even small shocks can escalate quickly. Gold's role here is almost psychological as much as financial. It acts as an anchor in a world of floating promises. When central banks add gold to their reserves, they're not chasing yield, they're buying insurance. Historically, gold has preserved purchasing power across centuries, surviving empires, wars, and currency resets. That history matters in moments of uncertainty. Silver, meanwhile, reflects a different tension. Its price is influenced by monetary fear and industrial optimism at the same time. When economies slow, industrial demand weakens. When monetary stress rises, investment demand strengthens. The push and pull between those forces often leads to sharp price moves, which seasoned observers watch closely for signals about broader conditions. What makes the current environment particularly tricky is timing. Central banks are trying to thread a needle, cool inflation without crashing growth, normalize policy without breaking markets, and reassure the public without lying outright. That's a narrow path, and history shows it's rarely navigated perfectly. In the 1970s, inflation was allowed to run too hot for too long, eroding trust. In 2008, risks were underestimated until it was almost too late. In both cases, the aftermath reshaped financial behavior for decades. The lessons from those periods loom large in Basel discussions, not as academic exercises, but as cautionary tales. There's also the issue of leverage, which quietly amplifies everything. Leverage means using borrowed money to increase exposure. It boosts gains in good times and magnifies losses in bad times. Over years of low rates, leverage crept into every corner of the system, hedge funds, real estate, private equity, even government budgets. When conditions change, leveraged structures unwind faster and more violently. This is why sudden market moves can seem disproportionate to the news that triggered them. It's not the news itself, but the forced reactions it causes among highly leveraged players. Central bankers know this dynamic well, which is why they monitor not just prices, but positioning, funding markets, and cross-border flows. Ask yourself this: if the people with the most data, the most models, and the most influence are privately hoping for smooth outcomes, what does that imply about certainty? It implies humility, but also vulnerability. Complex systems don't fail linearly, they fail suddenly. Everything looks fine until it isn't. That's why phrases like, "we're praying nothing goes wrong," carry so much weight. They acknowledge that despite planning, control is incomplete. And in those moments, assets, strategies, and assumptions that seemed unshakable are reevaluated. For individuals watching from the outside, the takeaway isn't to panic, but to understand context. Financial history is a story of cycles, not straight lines. Periods of stability breed complacency, which eventually gives way to correction. Basel's secretive tone reflects an awareness that we're late in one such cycle. Whether the adjustment is gentle or severe depends on variables no single institution fully controls. That uncertainty is precisely what keeps officials awake at night and brings us back to the question hanging over those meetings and over the future of the system itself, whether